and good morning, good afternoon, everybody. Welcome to the Abundance Blueprint with Kimberly. I'm Kimberly Lane Roberts, your host and the content creator. And we have a wonderful show. As typically, we have a driven male or female. In this case, it'll be Geff, and he's going to share his purpose and how he turned that into his passion. Before we get into the show, I always like to talk a little bit about if you are looking for something to help you grow your company and grow yourself. Very often that's difficult to do it by yourself. I run a Bay Area peer group here in the Bay Area. You can not only get executive coaching, but you also get access to the boards you can't afford, 12 other people that are doing exactly what you're doing and need the same support and have great experience, confidence, and insights. Reach out to me at Performance Leadership International. Great. All right. Now let's talk about our guest. We are going to meet Geff. Now, those of you might have already listened to a previous episode we had about a month ago where we interviewed Geff. That was episode number 1, talking a little bit about the financial credit scores. Here, we're going to talk about getting into a little bit more why 4 out of 10 Americans don't have access to credit, what he's changing in the lending landscape, and more. So let's meet Geff. He's not your typical fintech founder. With over 30 years of experience guiding startups and Fortune 500 giants alike, he's determined to break the mold to allow over 106 million Americans get access to credit. We have appropriately titled our show today, How to Break the Banks. Actually, how to improve lending without breaking the banks. And so we're going to talk to Geff right now. Geff, I'm going to bring you up. Geff is CEO of VeraScore. As you can see here, he's redefining credit access. Geff, how are you creating financial access for inclusion for all? And I know you typically have said and quoted 4 out of 10 Americans don't have access to credit. That's 106 million Americans. How are you changing that landscape?
Well, first, thanks for having me back on the show, Kimberly. It's great to see you again. To answer your question, the real challenge right now is that lenders just don't see customers or consumers accurately. Like I said, you've got 106 million Americans, or 4 out of 10 don't have access to credit. Now, half of them are credit invisible or unscorable, so they don't have a credit score at all. No one will lend to them. The other half, the other 56 million, are considered deep subprime, which means their credit score is 620 or below. So they do have a credit score, but it's too low for them to actually get a loan. So what we've developed is a score that sees people through their cash flow and how they perform over time, which is not actually how a credit score works. We've also flipped the model so that the consumer owns their data, owns their score. They decide when they want to use it. It's a very different model. So what that allows us to do is see everybody accurately and holistically, and then allow the lender to see them that way. So it's a very different model in that sense.
So how does that support, say, the Gen X, the Gen Z, the Gen Ys of the world? Obviously, they might not be using credit cards. They may be Venmoing or purchasing in other ways, or not using credit at all. So how is this changing that landscape?
Well, the way this is different, the traditional credit score is built on, it was built 50 years ago, and it came out of check writing books when you wrote bad checks. It hasn't evolved with the time, with data, and with access. For instance, they want, in order to have a perfect credit score, you have to have 21 lines of credit. Who needs 21 lines of credit? But that was back when you had 3 gas cards, a Sears card, a Dillard's card. You had all these cards for specific stores. You can live your life on a single debit or credit card now. And that's where the Gen Z and millennials are. And plus they're using apps like Venmo and Zelle to move money. So because we're looking at their cash flow, we're seeing actually through the method of their payment to how they're actually spending money. And that's how we're measuring them. So that's that holistic view.
I think you did a study at Tufts University. Do you want to talk a little bit about some of the statistics or what was run to address this particular population? I'll pull some of these slides off of here for you.
Yeah, so we partnered with the Tufts Consulting Collective, bunch of really bright kids at Tufts. Most of them were econ majors, actually, which was super interesting for us. And we asked them to do a project for us that was twofold. One, we wanted them to do a survey to understand how financially literate and or educated most people were. And they measured people between 18 and 30, but they were mostly college kids, but they got some above grad school. And then we wanted to understand how to market to them. That was sort of the second half. And that's we they got those results, and then we'll do another project with them in the fall that will take that and build that out. But this study was really fascinating. I think they interviewed 308 people, and they got the highest response rate of any survey ever done by a project at the Consulting Collective, which I thought was fascinating. And what they did was they went out to ask people about their financial literacy, and they tried a couple of ways to frame the question. But when they used my line of 4 out of 10 Americans don't have access to credit, they said people just got that immediately, sat down right in front of them and filled out the survey right there, which was fascinating. So there were a couple of really interesting takeaways on this. The first one is that 80% of people get their financial education and literacy from their family, which makes sense because you go to your tribe and who you know. And that's great if your parents and your family members are very financially literate, but a lot of people aren't. Financial literacy just isn't taught anymore. It's not really taught in schools. I know several people who have taught their kids how to get credit cards and how to save for retirement, but that's not the majority of people out there. And if you come from an underprivileged or underserved family, you're not going to have access to those tools or that experience to pass on to your kids. So that's super interesting that's where they're getting that knowledge from. So what we want to do is we want to promote financial literacy and education throughout our product as well. It's a big part of it. And you'll see only 15% felt very confident in their financial literacy, and over half were somewhat confident. And then the other 2/3 just really weren't. So it just gives us an opportunity to understand how we can meet those kids. And I say kids because most of these people are Gen Zs and millennials, meet them where they are and then bring them forward with financial literacy and education.
Yeah, I think they also proved in that particular study something about they weren't very confident giving their information through AI. Is that a correct statement? And how did you work around that with them or improve that confidence level based on how the app for VeraScore works and how you enlist them when they apply for any kind of credit?
Yeah, it's a slightly more subtle distinction. There were two things one, these are students that mostly use AI in their daily lives. But having said that, they're still not comfortable with other people using AI to look at them. Now, we don't use AI to calculate the score. That's an algorithm. What we do use AI for on the members dashboard is to provide you with targeted financial recommendations so you can improve your financial health. So that's a recommendation you can take or not. That's up to you. And then we use AI in the lender's dashboard to provide the right financial product and service for you that fits your financial needs at the time and will improve your financial health. So that's how we use AI. Once I explained that to them, they got it. What it brought up was an interesting area that we need to explain better, an opportunity for explanation of marketing. The other aspect of that was Plaid. Because we use Plaid to basically, we ask our customers to upload all their accounts via Plaid, and then we look at 2 years worth of transactions, read only, and then process a score, and then give all that information back to the consumer. They said there was a lot of concern about that, but again, 80% of their people are using Venmo, another 60 or 70 are using Zelle, and I think another 50% are using PayPal. If you're doing that, you're also using Plaid, but you're actually giving them the access to your bank accounts to move money in and out. Not doing, which I found fascinating. Once I explained that to them, they were like, "Oh, okay, that's easier." So it's really interesting that they're using these tools without really understanding the reach of that financial information and data.
Yep, agreed. So let's look at the opposite side, the lending side. You touched a little bit on that. I know you have some investors and you're starting out first with credit unions versus starting with financial institutions. I know credit union is a financial institution, but specifically a credit union. What are you hearing from people that are exposed to the system or see your demo as far as what's changing in the lending landscape?
It's a couple of different things. Once they finally, our biggest hurdle was, it's an alternative credit score. Well, it's a different credit score. It's not actually a credit score. So once we get them past that and we get them to understand that we're looking at only financial aspects, and we really look at consumers like S&P and Moody's looks at companies. And once they get that once they see that, they get really excited. We built this lender's dashboard, and when I explained it to we've got our first customers, a credit union out of the DC area, and Thomas is a very forward-looking CEO for a credit union. I explained what he was about to see, and he said, "Oh my God, we do all that by hand right now." So right now they'd have to open up, if they were going to get a portion of the information we can show them, they would have to open up 8 to 10 apps. All that information wouldn't be in one place. They couldn't share it or correlate it to each other. When I walked him through the demo and showed him how we could help him look at his consumers and then deliver hyper-focused, targeted financial products and services to what that consumer needs, he got really excited. He said, "Oh my God, you built the next version of a loan origination system." For those of you who don't know what that is, a loan origination system, whenever you apply for something digitally online, you're putting all your information into a loan origination system. Then they do the underwriting. And then if they give you the loan, all that data then goes into the bank core. So there's a bunch of systems that banks use. And we're sort of bypassing those to make this a seamless all in one piece, including adding advanced next gen decisioning to give you that loan based on our score. So he got really, really excited about that.
Yeah, I like how it helps serve both sides of the equation, the company or person lending, because it's showing what products might be customized and work for that particular candidate. And then the candidate also gets insight from the app about what they can be constantly doing to improve their health and improve their financial health through the VeraScore app that makes them more attractive to lenders. So I really think it overall ups the level of exposure to somebody's individual health, but also more importantly, they have control of it and can actively make changes versus waiting until they pay another bill on time, right? So, or credit card on time.
Yeah,
so,
I mean, that's the ultimate thing we're doing. I call it a triple win. It's a win for lenders. They don't need that much help because they're in a pretty good place. It's really a win for the consumers who, again, by explaining and walking them through this process and giving them complete transparency and insight and trust in the process that they have control over, which we've never had as consumers before. And then it's a win for the economy. If you've got stronger, more stable consumers, the economy gets better. I mean, that's exactly what happened in the 2009 home crisis. We didn't look at people this well. They were giving people loans with 825 credit scores, but they were inches away from bankruptcy, and you didn't know that because they were making their payments on time. And if that's all you care about, that's one way to do it, but we don't think it's a good way to do it. So it really does. It really is looking at that person holistically, and then giving the lender the ability to step in and help that consumer if they do lose their job, or if there is a medical emergency, or for some reason they're running into some financial challenges. And this is literally how banking was done 50, 60 years ago, where the banker knew the customer. They went to church with them. They saw him at the local restaurant. They were on the softball team with them. They knew that person and their character. So we're kind of creating the digital version of that, which makes it much more compelling for that lender to be able to understand and reach out and help that consumer.
Yeah, they're seeing the trends before the horrible thing happens, right? And then having to try to recover the loan, whatever it is. I also like too, this gives an audit trail. So a justification why they gave their loan to in the beginning and then appropriately where it sits today. So great. What is the number you'll be adding to the economy as a result of this with the access to more credit?
So that's really interesting. The economy, the U.S. economy right now is plus or minus $27 trillion, depending on what's going on. A full 2/3 of that, or 17 trillion, is based on consumer debt. That sounds a little scary to me, but you want that debt to be solid. Like I said, you don't want cracks in that foundation. Now that, again, is only based on 150 million Americans. You've got that 106 million, that 4 in 10, that don't have access to that economy. If we could add them at par, that would add another 12 million. But let's be conservative and say, well, we're going to add 7 trillion to the economy. What that means for the lender is that for each one of those people, you're missing out on $7,500 a year in interest payments. Who doesn't want an extra $100 a year in interest payments from a consumer? I'm just saying. And what it also does for the consumer, it gives them access to the products and tools they need to live their lives, to buy a home, to buy a car or furniture, whatever they're doing to live their lives. We want to help people live their lives, meet their needs, but put them in a place where they can do it safely, securely, and they don't overextend themselves.
Yes, and I think putting the power in their hands so they're not being dependent on a lender who's possibly telling them, oh, you're good to go, right? But then, really not setting them up for success. Great. In closing out, because we are up to our time, how can the audience help?
Well, if you're a CEO of a credit union, we'd love to talk to you, or a community bank. But if you want to invest, we are finishing out our late seed round, and we are taking investment. We're looking to raise about $4 to $5 million. that will get us 3 or 4 pilots and into revenue and before our A round. You can actually do it through pre-tax money in our account. We have that ability too, and I can send the link to that. But it's a really exciting time. As one of my recent investors said, this is like getting into Uber before it blew up. That was her phrase. I don't pick the company, but it's also it's nice to be involved. We also say that you can do well by doing good. This is
exactly that's what I love. Yeah.
The ability to help everybody, including the economy, which I personally think that's a good idea. But again, I'm drinking the Kool-Aid, so that's my position.
No, that's why you're taking your own personal journey and turning it into abundance for all. So I know you'll succeed. You're on that way. So thank you for being on the show again today, episode number 2. I will put contact information for Geff in the show notes, so you'll know how to reach him as well. We'll also post this on LinkedIn, and we'll tag Geff so you can reach out to him in that way as well. All right, we're going to say bye for now, Geff, and I'll see you in the green room in a second.
All right, thanks.
All righty, what another great episode. It's just really rewarding to see Geff and like so many other people I interview on the show really taking something that's passionate to them and turned to a purpose, not only for themselves because they struggled with it, but also for the purpose of all mankind. And that's, to me, is just truly coming from the heart. How can you not be abundant and feel good for that very reason? As always, if you are looking to thrive in 2005, not just survive, feel free to contact me to manifest your dreams into reality. I'm really good at that. I can tell you a couple stories of how that's happened for other people, and you might be my next person to do that for. Find a 30-minute conversation at www.performance leadership international. We're going to say bye for now, and thanks for joining us.